Okay, worst case scenario. We're still in the first 6 months. We're down with the first month. We have 5 months to go before June. Technically, what is in this playbook of yours that, and how do you advise investors to segment 2018? Do you advise everyone to sell in May and go away, as the street saying goes, or you think they should hold on a little bit and see how things pace out?
I think what we are recommending for clients is to do, first, if you've been involved in the rally of 2017, I like to think that you've enjoyed significant gain. In our base case scenario of 10–15% return for the market, we actually suggest that investors hold those positions. Because if you had bought GT, say, at 30 levels and it's currently at 50, it doesn't make sense, to add to GT at current level, because you end up increasing your average weighted costs. So just hold that position, because we think that, yes, along the line, as you've seen so far, GT still has some legs to run. And not just GT, I mean, across the market. So unless we begin to see signs of some of the issues that we highlighted that are possible triggers of some adverse conditions on the market, we do not think investors should sell in panic. There have been concerns as to whether the market is nearing a bubble. We do not think this market is nearing a bubble, unless, in fact, we stated clearly in that report that the bull market do not die of old age. Markets actually reverse when there are adverse shock.
Yeah, bull markets always die young, somewhere at middle age, never at old age, because there's always a room for a resurrection. True. And I like that. I like resurrection in the market. So you just give a bit of a very little example. But for those who may be looking at the full year, Q4 earnings coming through in February towards the end, do you think, if they think that, well, this market looks good, the numbers look good, let me get in here and get out before the electoral fever catches with everyone?
The thing is, I mean, at the time we were writing this report, we tried not to speculate. We try not to advise investors we try not to encourage speculative attitude in the market. We pretty much preach fundamentals, and earnings, as we expect, will be very interesting. We've started seeing numbers already for the period ended December. So there are a couple of companies in the market that have actually not benefited from this rally that we've seen so far. Opportunities still exist. As you stated in the reports, the return of 2017 pretty much is the market's first rally in 3 years. So we think the market even is pretty much just having its first full run in 2018. So, and also, just to allay the the election concerns as well, we also try to look at market performance in years preceding election down from 1999. And our observation is that even in years preceding election, the market actually tends to do well. 2014 was an exceptional case because of the crude oil challenge that we faced. So we do not think that, except the politics start getting so heated and we start seeing the Kenya type of, possibility of the Kenya type of election crisis, we do not think and we do not suggest that investors should sell in panic because, of election. We think that if you are invested, our suggestion is that if you are invested in a company that has very great fundamentals, if you've seen Q4 2017 results, if you've seen Q1 2017 results, and the performance are in line with expectation, in some cases exceed expectation, I don't think you have reason to exit these companies because the stock market is actually where investors invest for long term. Okay,
so that means hold on, don't panic.
But in cases where you've enjoyed reasonable return, because you, as an investor, when you go into a stock, you have a target return. So the risk-free assets offer you pretty much 13%, 12% levels these days. So if you've made 25, 30%, and you think you can hold the position if the market environment, if the market remains very favorable, you do not have reason to panic. But if you have obligations and you need to exit after 30%, it makes sense. 30% return in a year is fantastic for any investor.
I know what you're saying. Don't get greedy. That's what you're saying. Let's look at the second half when politics will start getting most of the grabbing the front page of the headlines. You said folks should not panic. But what do you see in terms of the underlying risks that you're advising investors to consider here?
I think if you go through the report, I think one of the reasons why we are skeptical, I mean, we've advised investors to also consider other scenarios of economic performance outlook is, I mean, we are actually of the view that the expected recovery in the economy is anchored on a very strong commodity risk, factor, which is, I mean, it's oil that's pretty much driving everything we see today. So as we progress towards the second half of the year, it's also very important that the investors, keep their eyes on what happens to the price of crude. As we speak, it's currently around $70 there are indications that prices will soften, down the line. OPEC promises to meet in June to reassess the impact of the November 2017 meeting. And if the compliance level is very high, there's a tendency that they would, continue to hold the line on their agreements. But again, the shale guys are pumping. The latest news we have is that production has gotten to about 10 million barrels per day, level, and that's at a record high. So, and our view is that it is a very strong, indicator to watch out for, because if production from the shale guys improves, that's going to give OPEC a run for its money. And also important that investors look out for some of the geopolitical issues that have also sustained prices at current level. If those geopolitical issues begin to recede, we also think that will have an impact on price of crude. Fundamentally, again, investors should look out for the global growth as well. That is also a very big factor that has sustained the price of crude even as of today. So if global growth begins to falter, if it doesn't meet expectation, we think the price of crude will. So the thing is, one, there are indications that government revenue will be impacted from crude especially. And also, do not forget, one of the reasons why this market has rallied so much is because of the improvements in the FX reserve that also encourage the implementation of the IE window and then the sustenance of that window till today. So investors should also watch out for that. I think these are the fundamental factors. Yes, election comes in around. If anything, election even creates more liquidity in the system in some ways. We expect to see more spending. Some of those spendings might find their way to the equities markets. So unless we see some real economic shock, I do not think political factor will be significant enough to force some major sell-offs in the market in the second half of the year.
So for this year, election is going to start revving up for the real votes. The calendar is going to be February next year, so we're technically 12 months from that from destination. Yes, for that major event. So on our political calendar after 4 years. So put together 2018 from the equity side and fixed income side looks a bit of a decent landing from your research, from your team.
Yes, for the fixed income side, not particularly an interesting story. The reason being, for the economy, yes, interesting, but for the average investor, not so interesting, because you want to benchmark the return you got last year and 2 years ago from what you expected to get in 2018. Hence the reason why most HNI investors are talking to us today, because last year they enjoyed a return excess of 80%, buying risk-free assets, 18% rather buying risk-free assets. So those yields have come down materially, as to speak, and are even expected to go down, as the year progresses. So yeah, if you have been this very risk-averse investor and you've enjoyed 18 levels, 19 levels in the past, 2018, unfortunately, is not that year for you, because government is pretty much interested in bringing these rates down, and central bank is also, and the MPC are actually working, to make sure that works out. So yes, for the fixed income, well, you also, for the international investors, it's a different ball game entirely, because what they pretty much do is to benchmark returns, with what they get elsewhere. I think at 13%, compared to rates in advanced market and even some strong emerging markets, the return on government the yield on government yield on government bonds at 13% still looks very interesting. More so because the FX is also very stable. So yeah, for internationals, it's a good game. But for the locals who have been very much used to the 18 levels, unfortunately, they will have to look for equities at this time.
Christian, I'm one of the local guys. Okay, so I better hold it over here.
Thank you.
Thank you very much for coming. Christian, Orajekwe, do enjoy your weekend. The head of research and strategy at Codros Capital, and that's drawing the curtain on this week's edition of Business Morning. And for today, I'll see you at the other side on Monday, bright and early. We have a very busy business week next week. Bye for now from Lagos.